This is insane. Covered call ETFs have become a $145 billion income revolution, built for investors who want steady monthly cash from large cap stocks while keeping skin in the market. Hi, I am George, and this is Channel Vest. You will see exactly how funds like SPYI, JEPI, QYLD, JEPQ, and XYLD stack up on returns, yield, risk, timing, and allocation so you can pick the right tool for your goal. Quick primer before we dive deep. These funds earn income by selling call options, which means reliable cash flow but a cap on upside when markets rip. Pro Insight option premium can be higher when volatility spikes, so timing matters more here than in plain index funds. Why it matters done right? This strategy can turn portfolio noise into monthly income you can plan around. You're with Channel Vest. This is your analysis. Hit subscribe now and drop a comment on which ETF you favor. Channel Vest provides research only, not an advisor, broker, or fiduciary. Education only. No personalized advice, no affiliate income. Full disclosures and description. One clarifier. Nothing here is an offer or solicitation to buy or sell any security. Here's the big picture. While most investors chase 2% dividends, covered call ETFs have quietly delivered roughly 8 to 13% annualized cash yield to those who understand the trade-offs. Yield means annual income as a percent of price. These funds have exploded to $145 billion because they turn option premium into distributable cash, not because they magically boost dividends. Pro Insight option income depends on volatility and moneyness, so the yield is variable and will rise and fall with market conditions rather than staying fixed. Why it matters if you need portfolio cash flow for budgeting, this category can compress waiting time, but you must respect the ceiling on upside and the tax profile. What are covered call ETFs? Plain English buy stocks, sell options, collect cash. The fund holds quality equities like the S&P leaders, then sells call options on those holdings to collect upfront premium, which it pays out monthly. A call option is a contract that gives the buyer the right to purchase shares at a strike price. Selling calls earns income, but gives away some future upside above that strike. Pro Insight's systematic call writing can reduce volatility and drawdowns, but it also limits participation in sharp rallies and can lag during momentum bursts. Why it matters understanding this triangle of stocks, options, and income helps you decide if you want smoother cash flow even when it caps blue sky gains. The Performance Leaders slide highlights 3 headliners you must know: SPYI, 3-year return at 14.3%, JEPI assets at $41.2 billion, and QYLD yield at 13.19%, each labeled directly on the graphic. Read it like an analyst. Return is a backward-looking total return snapshot. Assets flag broad adoption and liquidity, and yield shows recent distribution rate, not a guarantee. Pro Insight big assets can mean tighter spreads and easier trading, but not necessarily better returns. Yield can look huge at market bottoms when prices are lower. Why it matters: do not chase yield alone or size alone. Weigh total return, income reliability, and fees together. Stick around. SPYI is the performance monster. The slide shows 14.35% 3-year returns versus 9.65% for JEPI and 11.98% current yield, and tax efficiency with roughly 85% return of capital. Return of capital is a distribution that is not immediately taxable as income and reduces cost basis instead. Pro Insight SPYI uses a call spread approach which can retain more upside during moderate rallies, explaining the return edge shown here, but it may distribute more return of capital that later affects cost basis accounting. Why it matters if you want growth and income together? SPYI structure aims to keep more of the climb while still paying monthly cash. JEPI is the Wall Street workhorse. The slide shows $41.2 billion in assets, a 0.77 Sharpe ratio, and fees around 0.35%. Sharpe ratio is return per unit of volatility, a common risk-adjusted score. Pro Insight, large asset base plus low fees and a solid Sharpe, explain why advisors crowd into JEPI. The portfolio's equity-linked notes and covered calls can smooth bumps but will still lag in runaway bull legs. Why it matters if you prioritize liquidity, broad adoption, and cost discipline with dependable monthly income. JEPI is the category's benchmark for practicality. The Income Showdown chart compares yields across QYLD, XYLD, SPYI, JEPQ, and JEPI with a vertical axis from 0 to 15, clearly showing which funds sit higher or lower on the payout ladder. Yield means recent annualized distribution percent of price and is not promised forward. Key takeaways you can read off the picture: QYLD sits near the top end, JEPI trends near the low end, and SPYI and JEPQ cluster mid to upper range. Pro insight: higher yield often reflects deeper call coverage or selling closer to the money, which trades more upside for cash today. Why it matters: align the yield level with your need for cash flow and your tolerance for capping gains. The hidden risks nobody talks about are front and center. Capped upside means you miss part of a rocket rally after selling calls tax. Drag appears when monthly cash is taxed as ordinary income in many accounts. Correlation breakdown means these funds can still drop with the market, so they are not crash insurance. Ordinary income is income taxed at your regular rate rather than the lower capital gains rate. Pro insight: path dependency matters. A big rally right after you sell calls can leave you behind, while choppy sideways markets are where this strategy shines. Why it matters: know the cost of income, so you can place these funds where taxes are favorable and expectations are realistic. Join the Channel Vest community. Subscribe and comment to shape our next deep dive. Who should buy these? This slide calls out three groups. Retirees who need monthly income more than growth could use 15 to 25% of the portfolio. Pre-retirees around 50 and older can tilt 10 to 20% as income becomes a priority. Young investors are told to avoid because growth compounding beats income skimming early on. Pro inside sequence of returns: risk in retirement makes smoother cash flows valuable, especially when withdrawals must happen during weak markets. Why it matters: match allocation to life stage. The older you are and the more you draw from the portfolio, the more sense an income sleeve makes. The ultimate portfolio allocation frame sharpens it further. Aggressive under 50 shows 0 to 5% maximum because growth first is your edge. Moderate from 50 to 65 shows 10 to 15% for income diversification without kneecapping upside. Conservative at 65 plus shows 20 to 25% for steadier monthly cash. Diversification means owning exposures that do not move exactly together so that total risk drops. Pro insight: never let covered call ETFs exceed 25%, as the slide warns, because the upside cap can compound opportunity cost in prolonged bull cycles. Why it matters: set bands now so you can rebalance mechanically instead of chasing yesterday's yield. Timing cues are explicit. Buy when VIX sits above 20, when markets move sideways, and when interest rates are rising. Avoid when VIX is below 15, when a strong new bull is starting, when you are under 40, or in fully taxable accounts if the tax bite hurts you. VIX is a volatility index derived from option prices. Higher readings mean richer option premiums. Pro insight: the factor is premium per risk, not just premium size. Avoid forcing income in thin volatility because you are selling upside cheaply. Why it matters: with disciplined entries and account placement, you can tilt the odds toward better income for the risk traded. This slide is a pacing break that spotlights a subscribe now banner to mark the midpoint before conclusions and next steps. Use it as a checkpoint for your plan. Confirm your goal is income first, that you accept capped upside, and that you will size the sleeve within the limits shown earlier rather than chasing the highest yield on the previous chart. Pro insight: attention is a resource. A recurring review reminder embedded in your process reduces impulsive allocation changes when markets swing. Why it matters: pausing here helps translate these visuals into a written rule set you can actually follow when volatility rises. The bottom line splits the audience. For income seekers, JEPI is your best bet given its adoption, low fees, and dependable monthly distributions. For performance chasers who still want income, SPYI's call spread design has delivered stronger total returns as shown on earlier slides, while still paying near double-digit yield. For yield maximizers, QYLD sits at the top payout line, but it trades more upside and may be better for retirees who truly want income first. Pro insight: none is magic. Fees, call coverage, and market regime will swing relative winners over time. Why it matters: pick the fund whose structure matches your priority and write down a rebalance rule. We close with a deep financial question from the slide. If covered call ETFs can generate 8 to 13% yields, why do not more advisors recommend them to clients? Consider complexity, tax profile, and the reality that capping upside can underperform over long bull markets. The slide also teases the next video on YieldMax, ULTY, and SLTY, the high-yield ETF craze that demands careful analysis. Pro Insight Guardrails beat hot takes. Compare any high-yield product against your plan before chasing the headline. Why it matters, the right questions prevent expensive mistakes and keep you compounding. Hit subscribe, drop a comment, and we will see you in the next breakdown. Goodbye and take care.